Big banks are facing taper risk. We're taking a look at the week ahead. And Donald Trump, well, he's being Donald Trump. You're in the right place, folks, because this is where the money is. Well, David, it's a big week. As I said, we're going to be looking at some of the taper risk facing the big banks and those stocks. We're going to take a look at the events going on this week. But first, let's start off with the headlines, and we've got a big one here today. The first headline comes from New York Times Dealbook, and the headline is "Bats and Direct Edge to Merge, Taking on Older Rivals." So this is a direct blow to the NASDAQ, to the NYSE. Mm-hmm. These two upstarts merging, gaining ground. Is this the time to cut and run from your NASDAQ and NYSE holdings, or I guess ICE holdings, mm-hmm. now that that's in the process of acquiring NYSE? Mm-hmm. Is it over? Are the upstarts winning?
I don't know if it's a time to cut and run, but it's certainly cause for concern. When you look at this industry, it's all about consolidation, and these smaller players are consolidating. It's all about consolidation and technology, which is what they have. It's worth noting that these two companies are private, and they're going to stay private for now. They said an IPO is possible in the future, but it's not on the immediate time horizon. But I think they can compete. Why wouldn't they be able to compete? They're getting bigger. I think it said they'll have about 20% market share now, which will actually be bigger than NASDAQ. So it's not like it's some small player once these two entities are combined. So yeah, I think they can compete.
I don't know. I think that there's space for them, and I think as they merge and they get larger, there's definitely the ability to compete. But with the NASDAQ and the NYSE, you've got brand power there. I mean, maybe it's not as big as it is in, say, branded soft drinks or something like mm-hmm. that. But the brand of the NYSE and NASDAQ, I think in most cases, I will say, let's forget about NASDAQ's big flub last week, but in most cases you get investor trust and investor confidence with those names. Bats and Direct Edge just don't have that yet. So I don't know. I don't think that there's a big reason for NYSE and NASDAQ to worry quite yet. But in the age of electronic trading,
it's a little bit of a commodity business.
It's getting there. Mm-hmm. It's getting there, I'm sad to say.
All right, moving on to our second headline, we're going over to Bloomberg, and it says TD and CIBC deal to extend bank card buying spree, corporate Canada. So this is talking about TD Bank acquiring another credit card portfolio, something they've done in the past. And not just this deal, but when we step back and look at the Canadian banks in general, is this a space that you're interested in? Is there good value in Canadian banks?
The interesting thing is that after the financial crisis, after the U.S. financial crisis, everybody was looking at the Canadian banks and saying, look how well they held up, look how safe they are, we should just be buying Canadian banks. And then U.S. banks should emulate Canadian banks, and fine. There is a good system up there. I think they're very well-run banks. However, these are very highly leveraged banks, particularly compared to the U.S. banks, mm-hmm. the way that the U.S. banks are capitalized now. There is potentially a brewing housing bubble, and I hate to use the word bubble, but our colleague Morgan Housel has written about this, and the housing market looks a little maybe overblown, at least heated. We'll mm-hmm. say heated, at least a little heated, and so there's some concern there for the banking industry. And then finally on valuation, we talk about Wells Fargo here as when we bring up Wells Fargo, oh, that's an expensive bank. But Wells Fargo is trading at about 1.5 times tangible book value. Mm-hmm. And we think of that as expensive compared to the other U.S. banks. Up in Canada, BMO, Bank of Montreal, trading at 1.9 times tangible book value. CIBC trading at 2.4 times tangible book value. Both Bank of Nova Scotia and TD trading at 2.4 times tangible book value. And finally, RBC trading at 3.1 times tangible book value. So am I buying Canadian bank stocks right now? No, I'm not. I'm buying U.S. bank stocks, and I'm going to wait for there to be some sort of hiccup that'll get the Canadian bank stocks a little bit cheaper.
They certainly look expensive when you compare them to the big U.S. banks.
David.
But not as expensive when you compare them to the next step down. If you look at U.S. Bancorp or a BB&T,
they're not expensive compared to Google either.
Oh, okay. Well, we're getting off track there. But they do look expensive, yes, compared to the big four. But when you move down the ladder, they don't look as expensive. And you mentioned the leverage. It's safe to say that leverage can be bad in certain circumstances when it's over-leveraged. there is a right balance of leverage too. You could argue that the big U.S. banks don't have enough leverage, aren't getting enough return on that equity there to justify even those depressed multiples. So do I think Canadian banks look dirt cheap? No, I'm with you on that. But do they look super overvalued? No, not necessarily. I don't think that I wouldn't call you crazy if you bought a Canadian bank today. I wouldn't necessarily praise you for being a
very high bar.
A Bruce Greenwald value investor, but no, I don't think they're super overvalued. But I agree with you that I think there's some better deals in the big U.S. banks.
Finally, heading over to American Banker, the headline is "Banks Look to Consolidate Auto Lending Gains." And after the financial crisis, we saw a lot of dedicated auto lenders get into some trouble, and the big U.S. banks were able to pick up some of that slack and get some extra lending there. Is this going to continue? Is this a good thing? Is this something that should make big bank investors sleep a little bit better at night?
I think it's a good thing for everybody. When you talk about being just a dedicated auto lender, I think it makes more sense to have it as just a segment of one of these big banks. It's not. It can be a riskier type of lending, and you see that with the interest rates. They're higher than a mortgage, not as high as a credit card, which is an unsecured loan, because you do have the car there as some collateral. But it does make sense for it to fit into these lending practices and lending segments at these big banks. We saw Wells Fargo, JP Morgan, Bank of America, and Capital One, which is aggressively moving into the auto space. Those are the big four traditional banks that are dominating the auto lending. So I think it's a good thing for them. It diversifies their lending, and they get that higher yield on it. And I think it's a good thing for just the auto lending in general, because when you just have someone who just does auto, when things can go bad a little bit, you can see them really cede from that space, which is what we saw, which has allowed the banks to come in there and take up that space.
I don't want to agree with you, and it pains me to agree with you, but I can't think of a good reason to disagree with this here. And in particular, when we look at the lending landscape right now, that banks just aren't finding a lot of opportunities to put the capital on their balance sheet to work. So to be able to have a growing opportunity in the auto lending market, I think that's a good thing. And as you were alluding to, compared to mortgage loans in particular, I think during this particular downturn, the last one, and credit crisis, it was housing driven. So we saw a lot of the housing loans go belly up. Less so with the auto loans, less so at least than what you'd expect given what happened with the home loans. So less so with the auto loans, less so with the credit cards. Can banks get into trouble with auto loans and credit cards? Absolutely. But it's not, I think, well managed. This is a great area for them to be in, and frankly, they can get a little bit better on a little bit higher interest rates than on a typical mortgage loan, and that's not a bad thing when you're in this low interest rate environment.
And it's worth noting for the banks like JP Morgan and Bank of America, who have a lot of markets business and investment banking business, if the appetite comes back for securitizing, I don't want to, it's a dirty word in some circles, but if we get back to
Wall Street.
to securitizing some of these auto loans, they do have that segment as well. They can stand to benefit on both sides from the holding it on their portfolio and also turning around and securitizing it. So if we get back to that appetite in the marketplace, they might be able to take advantage.
Thank you, Mr. Wall Street. All right, so looking ahead, well ahead, out to the next year. I personally think towards the end of this year, we will see the Fed start to at least taper back, there's that word, taper back some of the bond buying. And I think probably by early to mid next year, and I totally could be putting my foot in my mouth by making predictions like this. Early to middle next year, the bond buying will be done. And I think there will be enough economic traction that towards the end of 2014, we could even see the Fed starting to move its core interest rate away from that 0 to 1/4% type of range. So this has got everybody fired up about bank and financial stocks. This is going to be terrible, rising interest rates, blah, blah, blah. Are you avoiding bank stocks with all of this going on? Is it dangerous to buy bank stocks right now and over the next year?
I don't know if it's dangerous. That sounds a little scary, but there are some concerns.
Danger usually is scary, David.
Yeah, okay. So we look at if rates rise, let's just go through some of the scenarios about how does this impact the banks really. So rising interest rates impairs their book value because most of these big banks hold very, very large securities portfolios of agency mortgage-backed securities, treasuries. When interest rates go up, those lose value in the marketplace, and they mark those losses in that other comprehensive income that's under the net income line. So it hurts the balance sheet. So rising rates hurts the balance sheet in the immediate present right there. The other side of that is usually with rising interest rates, it's because the economy is doing well. There's loan demand. However, if rates rise and there's not that demand for loans, I mean, we've already seen loan demand be pretty tepid. Not a lot of businesses are out there borrowing right now. We have cash balances, corporate cash balances at an all-time high. So my concern is if rates rise and there's not really that economic growth behind it, you're going to see very, very, very tepid loan demand out there because businesses already have a lot of cash. What's the motivation to go out there and borrow at higher rates than what they already are at now? So that's my concern. If rates rise and there's not the economic growth behind it, that's when you should be concerned a little bit about the banks.
So you're painting a terrible overall picture here to justify your position. All right,
basically.
That's fine.
That's the concern. That's the worst case scenario, I think.
Okay, let me start out here because we're talking about the Fed and what the Fed's doing. So Heather, you can throw up that chart. This is a chart that I put together of the QEs, the various QEs, their start and their finish. And so you'd expect that with a QE, quantitative easing, that when one of them started, interest rates would be pushed down. And then when one of them ended, interest rates would go up. That's certainly what everybody's expecting now, that the Fed tails off QE and interest rates are going to go up. But if you look, it's QE after QE1 started, 6 months later, interest rates were higher. After QE1 ended, 6 months later, interest rates were lower. QE2, after the start, they went up. QE2 after the end, they fell. And QE3, 6 months after that started, interest rates fell. And hat tip on this to, again, our colleague Morgan Housel, who has said this to me many times before, but I don't like to believe Morgan, so I've got to pull up the numbers myself, and of course the numbers prove it out. So when we're thinking about what the Fed's doing and we're trying to anticipate what's going to happen in interest rates based on what the Fed's doing, this kind of suggests that maybe it's a little bit more difficult to predict, or maybe it might even go the opposite direction of what people are expecting. So that's number one. If the Fed tails off its monetary accommodation, we could actually see interest rates go down. And certainly in anticipation of pulling out of QE, we've seen interest rates go up. So maybe some of that comes back out when the Fed, it's sort of like the buy the rumor, sell the news kind of thing. So that's number one. So we don't really know what's going to happen there. Number two, U.S. bank stocks, particularly at the larger end, are cheap. And I think some of that cheapness is still anticipating what happens when interest rates rise, because we've been in this low interest rate environment, so investors may be looking ahead and saying the low interest rate environment isn't going to last and banks are going to get hurt as interest rates rise, which is kind of true, as you explained. But it's also kind of not true, because as interest rates rise, banks make more money. And then finally, I'm not going to be as pessimistic as you, and I'm going to suggest that just as the Fed has said, they're going to start pushing interest rates back up once unemployment has gotten to a certain level, once the economy is recovering. So they're looking at both sides of the coin. They're looking at inflation, but they're also looking at full employment and economic progression. So I don't think we're going to have that doomsday scenario that you're painting for us. So here's my take. I wouldn't be going all in on bank stocks right now, or financial stocks in general, all in. But I generally don't handle my investments that way. I think you can buy bank stocks right now, but you leave yourself some room. You leave yourself some breathing room to be able to say, okay, well, interest rates go up, the market overreacts, and you get an opportunity to buy again at the same price, or maybe even a little bit cheaper. And so I think what you focus on right now is buying the right bank. So not necessarily just going for the cheapest, but looking at the capabilities of the bank, the management of the bank. Which bank do you want to own for the next 5 years? And in a rising interest rate scenario, which do you feel comfortable holding through that? So frankly, I would say that for most of the big banks. I would say that for most of the banks under that. When you get to some of the smaller regionals, I think you want to be a little bit more choosy within that group. But Wells Fargo, I'd feel very comfortable owning through a rising interest rate environment. JP Morgan, I'd feel very comfortable holding through a rising interest rate environment. Citigroup, yeah. Bank of America, for the most part, there's gonna be. I think you're gonna sweat a little bit more with that one because there's still there's still a lot more expense overhang in there, and the interest rates are going to hurt that short term, and you're gonna have to wait to see the benefit out in the longer term.
Right, and I think just you were saying, well, if this happens, maybe people overreact and trying to gauge what happens the next year. I think that just highlights how hard it is to say what's the interest rate environment going to look like over the next year, and it's almost foolish, lowercase f, to try to predict this. And I think what you have to do is, like you said, look at the banks, find the bank that's going to thrive in the most optimal interest rate environment, whatever that is. So over the next 5-10 years, which banks have the best earnings power, which have the best franchises behind it? So in an ideal scenario where long-term rates are high, short-term rates are low, and they can borrow down here and lend out there, get the investment banking firing on all cylinders, mortgage banking doing well. Which banks are going to do that in that great scenario? And then those are the ones to buy through all of these cycles here. I mean, you can't time these cycles in terms of when interest rates are going to be high and low. So I agree with you. When you talk about a Wells Fargo, JP Morgan, they're going to thrive through these cycles. We saw them thrive in the low interest rate environment with mortgage banking, and we saw them thrive pre-crisis, maybe a little bit too much in some areas, but they managed through the cycles, and I think those are the banks that you have to look to.
But we don't want to play off the risk here. When you go through a cycle change, there's risk that comes in. But when I look at the capitalization and the balance sheets of the banks today compared to 2006, it's a much different picture. So the risk part of it, will this bank potentially run into big problems as the interest rate environment changes? I have significantly less worry about that today.
Right, and we can get into a whole nother discussion how you classify risk, whether it's some classify it as the permanent loss of your capital there. I think there certainly could be temporary losses of capital if interest rate environment gets volatile. Bank stocks could get hurt. But in my mind, I think that's a temporary loss of capital. And like you said, maybe not going all in and being able to take advantage of those lower prices.
Now looking ahead, shorter term, it's the final week of August. David, what is on your calendar to be watching this week?
It's a little bit of a slow week, and I pulled a tweet. We're not to our tweet segment yet, but we got a tweet from Alice Lomax, and she said, "Welcome to the annual deadest week in the financial and investing news and info. Next week, rockin' and rollin'." So not too much of a crazy week. We don't have any Fed announcements, which is my favorite thing. The one thing that we will get tomorrow is Case-Shiller housing index numbers for June. Okay, and I stress June there because we really saw interest rates start to rise end of June and into July. So we may not see the full effect if there was an effect on housing prices because these are for June, but they'll be interesting to watch. We've seen the annual rate of appreciation for Case-Shiller last month for May was around 12-13%. So a pretty darn impressive
the expectation is right around that for June.
I believe so, yes. So it'll be interesting to see where are those still trending up, and they're maybe not the best housing numbers to look at because Case-Shiller looks at 20 metropolitan areas. It doesn't give you kind of the full range of what housing prices look like across the entire country. So we'll get those tomorrow. It'll be interesting to see if the higher rates, which started to creep into June, affected the home prices. So I'll be watching that.
So Case-Shiller is on my list as well for tomorrow. And then it's Thursday, we get the second estimate for the most recent GDP numbers. And
second of like 87
exactly. So just as a refresher, we get the advanced reading of GDP, and then they do a second estimate, and they do a third estimate, and they're continually refining using better and better numbers each time. So this is something to watch. It may not sound like a big thing, so you're re-estimating GDP numbers that have already come out, but the changes can be pretty significant from estimate to estimate, particularly from the advanced to the second estimate. So this will be something to keep an eye on. And of course, when we talk about interest rates and the Fed's actions, which we were just talking about in the last segment, the pace of the economic expansion and recovery, that's a big part of it.
And the one thing about GDP too is the recent readings been trending a little bit lower as kind of just an overall number, but it's important for investors to look kind of underneath the hood, because we've noted a lot of that decline is due to government spending, which is a component of GDP. So the actual private sector has been doing fairly well.
But I would say a little bit better. I wouldn't say fairly well quite yet.
But you do have to look under that headline number and say what's going on here, what's dragging it down, and what's being dragged down by that government spending.
And then on Friday, as far as economic releases, we have the University of Michigan's consumer sentiment number. I think that there's still a lot of sentiment issue that is holding the economy back, both on the consumer side and on the business side. And I'm continuing to look for that starting to move in the right direction. Expectations right now are that that's going to be moving in the wrong direction, at least for this month. But bigger picture, we want to see sentiment recover a little bit more. So individuals are spending, which make up a preponderance of our economy, and businesses are spending as well. On the earnings front, we're starting to wind down earnings season, but since we were just talking about Canadian banks earlier in this show, I should point out that on Tuesday, tomorrow, both Bank of Montreal and Bank of Nova Scotia are slated to report earnings, and then on Thursday, CIBC and RBC are both expected to report earnings. And I just say, with rich valuations, one of the things that investors are going to want to look for is that they are not only meeting but exceeding expectations, because when you are when you have a stock that's valued like that, earnings disappointments can be met with sell-offs. I'm not predicting anything. I'm just saying that can often happen.
Yeah, you talk about the Canadian banks. Most of the American financial companies have already reported second quarter earnings, but we're already 2/3 of the way done with the third quarter, so it's going to be here before we know it. I know how much you love earnings season.
Oh yeah, it's great. And then finally, it's going to be a quiet week, like you said. We've got the 3-day weekend coming up. We've got payroll numbers next week, so we'll have a lot of people looking towards their beach vacation this weekend, and we'll have a lot of people looking towards payroll numbers next weekend. So it'll probably be relatively quiet overall.
Right.
And finishing off, as always, on the Twitter sphere, David, why don't you kick us off?
First tweet we are looking at today is about MasterCard, and it's from MasterCard at MasterCard News. We're thrilled to be bringing the power of debit to Sri Lanka with Nations Trust. So this caught my eye for a couple of reasons. One, when we think about MasterCard and Visa, of the two, MasterCard is a little bit more internationally focused. So they have more of their revenue coming internationally than Visa does. On the other hand, Visa has much more of a dominant share of the debit card market, which is a couple weeks ago we saw the debit interchange fees being questioned by the Fed in terms of what those caps can be for the banks. And we saw the resulting impact on Visa was down like 8%. It was one of its biggest one-day drops in a while. Because the thought of if banks stop offering debit cards, that'll take away other revenues that Visa gets from the debit card. So Visa is bigger in the debit card space. Interesting to see that MasterCard continuing to move to these Sri Lanka. I mean, who would think?
Which is where there's a lot of the opportunity.
Yeah,
for credit card
that's where most
right?
of the opportunity is. So it's MasterCard continuing to move internationally.
The opportunity, I'll tell you, the opportunity isn't with me with 3 credit cards or 2 credit cards and a debit card already in my wallet.
Right, and you talk about just the value proposition they offer. We don't really think about it too much just having a credit card in our wallet here. It's kind of just second nature. But when we talk about these other nations that don't have the access to this, it offers security. It offers ease of payment rather than having to go to the ATM and carrying around cash. This serves as ATM card, and they can pay with it. So it's really a great value proposition when you just think about the business. So it's good to see that MasterCard's still expanding, still moving into the debit card area, and they're offering a good service, which is why you've seen the stock shoot up like a rocket since it's IPO'd, which both of us have missed out on, but still a great company that's performing well.
Yeah, to remind me. Moving on to tweet number 2, we've got a tweet from Business News, and the Twitter handle is @BizTradeNews, and the tweet reads, "Bank stocks still a massive risk to your portfolio? and this is a sentiment that I couldn't disagree with more, there's headline risk. If you worry about headline risk for your portfolio, if you are concerned about having the name of your company questioned in the media day after day, week after week, sure, there's risk there. But what am I concerned about? I'm concerned about business risk. I'm concerned about capital loss, the risk of capital loss. And as far as business risk, I'm looking at all of these, and I hate to always be focusing on the biggest banks, but frankly, that's where I think some more of the opportunity is. And as far as business risk, I look at the businesses of these companies, Bank of America, Citigroup, both moving more and more in the right direction, improving the business, fixing the things that went wrong during the financial crisis. JP Morgan and Wells Fargo, solid before and during the financial crisis, and I think both solid and performing now. Yes, we've seen JP Morgan in the headlines all the time lately, but the nature of these investigations in the headlines, I don't think is really going to impact the bank long term. So am I concerned about this massive risk to my portfolio? I am not.
I agree. The article points out to JP Morgan being in the headlines recently, and it basically says, if JP Morgan's in the headlines doing this stuff, all the other banks must be doing it. Nothing's changed since the pre-crisis era of the banks, and they're all still possibly going to zero if there's a big catastrophe in the financial world. You have to step back and look at some of the numbers. I mean, I know you can argue that banks can fudge some numbers sometimes, but you mentioned capital ratios. Capital almost double at most of these banks. Leverage way down from what it was. And that's really what got the banks into trouble pre-crisis. Yes, they made some bad loans. That happens. But it's when you're very leveraged and you make bad loans, that's when it can really hurt you. So leverage way down from those pre-crisis levels, capital ratios way up, and the businesses are performing well. We see record profits at JP Morgan and Wells Fargo. So I think it's a little bit lazy, in my opinion, to say nothing's changed with the banks. They're all still the same. Look, they're still in the headlines for doing bad stuff. I think when you actually step back and look at the numbers from a stock perspective too, because that's what the article is talking about. It says to your portfolio. Mm-hmm. Yes, it's a risk to, I don't know, to how if you feel warm and fuzzy about banks, that's a risk, sure. But to your portfolio, I think when you look at the numbers, it's a different story. All right, the last tweet, talking about your boy, Donald Trump.
My boy, thanks.
Yep. We got it from HuffPost Politics at HuffPost Paul. Donald Trump calls New York's Attorney General a political hack. Thoughts?
It's the rare occasion that you will see me agreeing in any way, shape, or form with anything that Donald Trump has to say. Not that I have anything personal against Donald Trump, I just don't tend to agree with most anything he ever has to say. However, and I'm not going to say that I'm thinking of Eric Schneiderman as a political hack, as Donald Trump is describing him. However, the AG of New York, that particular position, I'm not going to say that that Schneiderman and past AGs haven't done some very good things, because they have, and it's a very difficult city and state to watch over because of the large financial base there. However, you've seen a lot of political posturing, I think, over the years from the AGs of New York. And you've seen a lot of AGs go on from that position to climb up to higher and to climb the political ladder. So is it possible that New York's current AG Schneiderman is doing some of the same thing? It's possible. And when I look at what's going on with some of the banks and some of the investigations into the banks, it makes good headlines and it makes an AG look good. So again, I'm not going to go to the same extent that Trump. I wouldn't go to that extent, but in a rare circumstance, kind of seeing where Donald Trump is coming from.
You mentioned it makes good headlines. I think Donald Trump was probably like, I haven't been in the headlines in a while. I need to say something so I can get the Twitter sphere talking about me again. So I think that's all it is. It's good news.
You're not on board with the Trump here.
Yeah, whatever. One day.
All right. For David Hansen and Donald Trump, I'm Matt Copenheffer. Thanks for watching, folks. We'll see you tomorrow.